What's up YouTube? It's Todd Horst here with Tasty Tracker. Today we're going to go over option Greeks. Let me first start by saying that this is just my take on Greeks and I am by no means the most knowledgeable person, but I do think you'll find this video helpful. So let's just get the basics out of the way and then we'll try to move on. I'll show you some examples and try to impress upon you how I feel these are important or not important. So first up we have is theta, is the Greek name, and you can think of that as time decay. That's easy to remember because they both start with T's. Vega is volatility, and most people will hear about IV crush and aren't necessarily familiar with what that is. So we'll go over that in this video. The next two are delta and gamma, and they're sort of tied together. You may have heard of gamma risk, and we'll go over that. And then rho is the last one. So you can think of these Greeks as making up the base price of an option. That's not necessarily true. It's more of an indicator of what price will be. But for all intents and purposes, if you run these figures through a calculation, it will spit out a number, and that's around what will happen to a price going forward. It's standard practice to use the Black-Scholes model. There are alternatives to Black-Scholes, but it's one of the easiest and closest to being accurate, and so I have a calculator for that, which is the next bullet point. That we have a couple tools on under the lab section of Tasty Tracker, and it's really just nerdy fun, and it's not necessarily a tool that I see people using on a day-to-day basis to make their trading lives better or anything like that. But it might help you get started going down the road of understanding what they are. So let's go ahead and show that. So the first up is the Black-Scholes calculator. When you load this page under Lab Black-Scholes, it'll come out with all of this stuff pre-filled. So it doesn't really matter what underlying you're talking about. It's just the price of it that matters. And then again, it doesn't matter. You could choose any strike here, but we default to 35. Volatility is something that you could put in a number, but it's the percentage, and as with all of these numbers, it's kind of obscure as to what you should choose. That's why I pre-populate them. Interest rate is just one. Dividend yield, this would be for an underlying that doesn't have a dividend, but so it'd be kind of like a growth stock or something like that, but most ETFs have a dividend. And then the days to expiration. So if we were relating this to the Vegas or to the Greeks that we just talked about, this would be Vega. Interest rate is rho. Dividend, I'm not even sure where that would fall under. Days to expiration is theta. So if we hit submit here, it spits out these numbers. So the price of the contract that would be at a strike 35 for a call, this is the call column, here's the price, and then here are the different, excuse me, here are the different Greeks, and then your put side. And so all of this, again, is not really helpful. What am I going to do with any of this? And the answer is really nothing. But what this leads to is once I was able to have the Black-Scholes formula working, I was able to put it off into a payoff schedule. So let's just select a bull call, which is when a user buys a call. In this instance, we're going to put SPY, and we're going to put that the current price that we're paying for this long call is a debit of $27. We're buying the 303 strike with the expiration of 9/18. So I hit submit, and it's going to run through the Black-Scholes and then calculate where you're going to be profitable and the value of each one of those contracts between now and then for all of these strikes, and then that's where you get this payoff diagram. So it's basically as simple as that. And this is helpful if you're trying to see what where a position might be, what the payoff would look like. So let's go to an iron condor. And the market's closed right now, so this will have more gradient. But you can generally see that with an iron condor, you get the payoff in once you stick between these two ranges. The settings were between 303 and 313. So anyway, yeah, this is helpful if you want to see what a position diagram looks like. And if we go to our account positions, we have payoff right here. And so we can see then a payoff. So that's where it's helpful. So anyway, let's get back into the presentation. Okay, but what actually determines the price is the spread. That would be the bid and the ask. So what people are willing to sell the contract for, what they're willing to buy the contract for. In general, what the market is valuing that option contract for is what the price will be and what you'll get filled at. So even though the Black-Scholes says that on this given day, this contract should be worth this much, the reality is somebody might not be willing to buy it for that price or sell it for that price. So at the end of the day, it's only that connection, that human connection with somebody else, that is what creates the fill. So my general opinion here is, with a car, you need to understand how the main parts work, generally speaking. That's extremely important. You need to know that the engine connects to the drive shaft, they spin the wheels, your alternator helps with charging your batteries needed to run the electronics and to jump the engine to get it to start, these kinds of things. Again, I'm no mechanic either, but I have a basic understanding of some of the pieces of a vehicle. But understanding the cost and the exact specifications that those pieces were manufactured to is nice. That's nice to know that level of detail with a vehicle, but does it actually make you a better driver? The answer is no, obviously. And many times, if you're talking about NASCAR or something like that, the drivers, again, are knowledgeable on the vehicle, but their mechanics are going to be more knowledgeable, and the mechanics aren't the drivers. So what we want to do is educate ourselves enough to be the most effective traders and investors, not necessarily be the nerds that could generate the calculations for any specific contract. So I hope you got the analogy there. It's good to know this stuff, but keep it as high level and practical as you can is the most beneficial. Okay. So as you know or should know by now, the contract of an option is made up of extrinsic and intrinsic values. The Greeks are part of the extrinsic because they're external factors. The interest rate could change. The time is always ticking, so these are factors that are changing outside of the contract. The intrinsic part of the contracts are the difference between the strike that you chose and the underlying actual price. So that's not directly part of the Greeks. It's important to understand as well that each contract will have its own Greeks. So if you buy the SPY call at 300, that will have different Greeks than the SPY put at 300. And say it's for this expiration, that will change for next expiration, even if it's the same strike, same underline. So every single individual contract has its own associated Greeks. Then say right at the money, that's what ATM stands for. Right at the money Greeks are going to be affected the most than when you come out on either side. So above and beyond, above and below, um, uh, a specific price. So if SPY is at 300, the 300 strikes are going to be wildly affected by any move in SPY. When you get out to 305, they're affected less. When you get out to 310, it's affected even less, and that goes on both sides, above and below. So you'll really see sort of a, let me go the other way. So something like that, like a triangle part where at the money is going to be the most affected by the movement, and then it gets less and less affected. That's why you'll frequently see us rolling up and out our positions, or just rolling up. If a stock continues to move higher, it's better to close out your position because okay, so say I bought a call in Amazon and it's had an exponential move up. I want to close that call, buy another call that's higher, which will be cheaper, and then have Amazon come into that one as well. And you'll make more money that way than by holding on to that original contract, because the further and further away Amazon's underlying price gets to from your strike price, the less your contracts are affected. So you want to keep on top of it within reason to make the most. Obviously, that has a chance of backfiring if you move your contract up. Then Amazon doesn't go up, and it instead comes back down again and would have been above your original position, but you would still lose money that way as well. So anyway, that's something to think about. Okay, so now I'm going to show in Robinhood, Thinkorswim, and Tastyworks. And honestly, Thinkorswim is by far the best in this area, but we'll jump into that. So first I'll show you Tastyworks. I went ahead and added, normally my columns stop at the extrinsic because I like to see everything from here over, but certainly you'll get used to your own views. To change this, you click on the little cog, and then you can select which items you want to use and not use. But you can see what my columns are here that I normally use, and then the columns I added here are delta and gamma, which are related, and theta, vega. Last one here is just for fun, the IV percentage. So that's how you would see those in Tastyworks. In Robinhood, you would go into the trade options screen and click on any individual strike. And then at the very bottom of the details for that strike are the Greeks. They actually list row here, which is nice. In Tastyworks, that's not an option. Then in Thinkorswim, you need to go to the Trade tab, Options Chain, and you can change individual columns to be whatever you want. So if you click on a column up here, you can go down to Options and Greeks and then choose from the options up here. However, the easiest way is to click on Layout here and then click on Delta, Gamma, Theta, Vega. To get it to display row, I went into Customize after selecting the Delta, Gamma, Theta, Vega view, and then I scroll down and added row and then hit OK. Typically, I keep this on, where is it? This one. Implied volatility, probability, out of the money, and delta. And then I change this to in the money, which is right here. The probability in the money is what I like to look at. So this is my normal view, or I might do the last and next change, and then again probability in the money. But for this case, we'll do the Greeks. Now I got to re-add row. Okay, so you can see here again the 49 strike call delta has a 0.7189, and then down here let's do 50. 66.75, and if we go down here to the 50, that's 62.84. So those are different because these are different expirations. This is the July and then this is the August. To only show 10 strikes here, I selected 10, but you can obviously show as many strikes as you wish. And that's going to be the case for all of them where they're different between these expirations. The right here, yeah, well, let's just move on. They're also different in between the calls and the puts. I think that's all I wanted to say there. Okay, moving on. So theta is what I trade off of mostly. Everybody has their different aspects that they like, but my sort of the cornerstone of my trading style is theta. I got this image from this link below, so it's not something I created. They have a link, a line down here for in the money, but you could have a mirror line up here for out of the money. It will again curve down maybe more than in the money because it has to end at the same spot, but you don't get this huge hump that you get where it's right at the money because they're going to be out of the money is going to be less affected than at the money, which we talked about before. So as you can see, the passage of time really starts to pick up here at the end of the contract's life right before expiration, decreasing the value of that option contract. So I already said this is our favorite, and I talk about theta overstated in episode 24. It's simply the passage of time, but it isn't linear in that it can pick up here. It does pick up as it's expiring. So every day you own a contract, which means you bought it, you are long it, these are all synonyms. But every day you own a contract, you lose money, and it's at an increasing rate. So theta decay is where I buy a call, and I think it's going to the moon, but say it's in Amazon. Amazon is still going higher and higher and higher, but it's not at a quick enough rate to compensate for the amount of money I'm losing on my contract. Partially, part of that is theta. Some of that could be a reduce in volatility, which we'll get to in a minute, but that will also decrease the value. So it's not so cut and dry the value of a contract leading up to expiration. Once it's expired, of course, if your contract is in the money, then you'll be fine. So ultimately, if you plan on holding that long, that's all that matters to a degree. But if you intend on closing early, that's where the Greeks may come into play a bit. So as a buyer, I tend to anyway buy more than 90 days out if I'm planning on holding for any amount of time, so that is least affected by theta. If you want to make a big swing, so you're doing a Wall Street bets day trade kind of style trade here, then you might do the next weekly or maybe 2 weeks away from now so you can get that big swing. But then it needs to be held for a short period of time. So either sell that day or within a couple days. Otherwise, theta is really killing the value of that position. And even if it's close to being right, it's going to be harder and harder and harder to walk away from that profitable. Sellers, you want to sell contracts around 45 to 60 days. 45 is the sweet spot where theta really starts to pick up, and so you can capitalize on that decrease in value to have the other end of that contract, the buyer, really be hit hard with their theta, and you're just making more money every single day based on theta alone. Okay, so volatility is the next, to me, important one. Volatility is overstated. I have another episode called Vega Overstated, and that goes over how people think larger moves are going to happen than what actually plays out. But generally speaking, volatility uh, is when the stock market or individual underlying is going up and down and up and down. Nobody knows where it's going to go next, and you can think of Tesla as a classic example here. At least for the past 5 years, Tesla's been that way. And so when it has great swings in the price, there are higher premiums because nobody knows where it's going to be. So any of those strikes in a very wide uh, breadth of strikes could become valuable. So even if Tesla is trading at $1,000, it could go anywhere from $500 the whole way up to $1,500. Nobody knows. And so the premiums across the board, that whole set of strikes, is going to be higher, and especially so at the money. Um, Whereas if you have something that is very, very stagnant, like Ford or something like that, you're only going to be a couple dollars uh, or percentage up and down from where it's currently priced. After that, volatility really at the contract level, and the premiums really go down. So as a seller of options, you want to go from a high volatility environment to a low volatility. This is called IV crush, and so many people are familiar with that when they are playing earnings. So if you're selling in high IV and then the markets are acting really crazy, then you sell a contract to open, you sell to open, then you can collect more premium because of that crazy environment and the risk associated with it. Then the market settles down, so volatility decreases, and now you buy to close that contract. Now you've just capitalized on volatility, and you can make money that way. So one strategy for this might be that as a seller, you open a position 48 hours or so before earnings, and it can be directional, it can be a neutral, but you're just trying to capture that IV crush that you'll see after earnings. As a buyer, you want to go from a low volatility to a high volatility scenario. So as a buyer, you might want to buy calls leading up to earnings, maybe 30 days out, 60 days out, when you see earnings coming up, because stocks tend to go up just before earnings, the weeks leading up to earnings, and volatility also goes up in that time. So if you buy the call early and then you sell it maybe 48 hours or 72 hours, something like that, before earnings, you can just capitalize on the trend up there in price and volatility. You don't necessarily want to hold through earnings as the buyer because of the IV crush that we've talked about before. And after earnings, what's unknown is known. And so volatility will automatically decrease under normal circumstances. So during the whole virus situation that we've been in, there has been times where there's been earnings or other announcements, and normally you would expect IV to be sucked out of that contract, and it's not been sucked out as much as it normally would be because the general market is volatile at the moment. But under normal conditions, after earnings, you'll see the volatility drop off. Okay, so I think volatility and vega, again, both start with a V, and theta are pretty easy to understand. We can get that during crazy times you would have to pay more to entice sellers, and time is always passing. So those two concepts are pretty easy to understand, I think. Where you get into some more heady stuff, at least for me, is delta and gamma. So I'll try my best. First of all, I want to say that if your broker doesn't have percentage in the money as a value that it will display, you can use delta as an approximate. They're not exactly the same, but they're close enough that yeah, that you can use that. I use percentage in the money as a seller to say how likely am I to lose this position. So what is delta? Delta is the amount an option price will move if the underlying goes up by $1. So calls have a positive delta and puts have a negative delta. A different delta, there's a different delta for a call and a put of the same strike, even if it's the same expiration or different expirations. So in practice, let's say we had a stock, we were looking at a specific strike, it had a delta of 0.5. That means that if the stock goes up by $1, your long call will increase in value, the contract itself, by $50. As always, these are lots of 100, so that's why 50 times 100 is $50, 0.50. So that's only the next dollar. And going with that is gamma, which is for the next dollar. So if it were to go up $2, what would your contract increase by? It's not going to increase by 50 plus 50. It's going to increase by 50 plus whatever gamma says the next dollar is on top of the original 50. So let's go over what this is. It says what the rate will be for the next dollar. It is the rate of change. You can think of it as a snowball. So it's going to increase again right with the at the money strikes, but what will the next dollar get you, and then the next dollar on top of the current dollar, and then the next dollar on top of that amount, so it will snowball. So while delta is for this dollar, gamma is for the next dollar, they're roughly the same for calls and puts at the same expiration, but you know, I'm not sure why you would look at the put side to get the call side. You should just look at the call side if that's what contracts you're looking at. But different expirations will certainly have different gammas. Although further out strikes are affected less, if the expiration is near, gamma will whip around your contract because it's soon decided whether that contract will have value or whether it will be worthless. So that's what people call gamma risk towards the end. So say I have a contract that's expiring this Friday, you'll see the prices whip around wildly, and by that point theta is basically completely out of the position, and it might not be that volatile. So vega and theta are kind of off the table, and you'll still see the contract whip around wildly. And again, that doesn't necessarily mean it will get filled at that, but what's happening is towards the end, gamma is higher because who knows if you're right at the money, because that the value of that option is either 0 or whatever however far that stock moves. So it's kind of coming down to the wire, and so that's why you'll see it move wildly. So continuing our previous example, if delta was at 0.5 and if gamma was 0.25, for that additional dollar, we get the $50 again, and this time we get $25 on top of it. So we get $75. So we got $50 from the previous move up $1, and now we get $75 on the next move up, totaling $125 if it were to move $2. Hope that made sense. Rho is the ugly duckling of the Greeks. Nobody talks about it. It's not even displayed in half the time. Like Tastyworks doesn't even give you the option. It does show it in Robinhood, which is surprising, and in Thinkorswim you can show it, but it's off by default. Nobody really cares about Rho because it has very, very little impact on positions unless you're buying them and holding that position. It's not necessarily buying. If you're opening a position and holding it for a long period of time, that's where row affects the most. But you're honestly not going to notice it between all of the other variables in play. So nobody ever gives it the time of day, but it is still a part of the calculation. Obviously, the interest rates are less likely to change between now and within the span of 60 days as they are 12 months or 24 months, etc. So that's why LEAPs are going to be affected more. Here I have a link to the treasury.gov, which shows the interest rate. You want to choose the 1 year. So right now you can see it's 0.17 is the interest rate. Okay. That's really all I have to say about that one. So just as a summary of what I talked about here, we use theta on our side as one of our primary pieces of our strategy. But understanding that theta is constantly chipping away makes buying options hard, in the sense that I know if I buy it, I have to contend with my break even being higher than the strike because I paid for that contract. And then I have to have a move sooner rather than later. Otherwise, theta is going to eat away at my position. So those two things, to me, I will do it on, like I got some leaps when the market really went down in SPY, because theta has less effect on leaps because it's so far out. But buying short term, I'll do occasionally, but I want to close that position out within a couple days at the most, preferably be a day trade, because I don't want to hold on and just have theta continually making it harder for me to be profitable. The next one is understanding Vega makes earnings hard. So typically I would not recommend earnings for buying or selling, but if you insist on playing earnings and you're buying, you have to do it at the right time. And if you are selling and insist on playing earnings, you have to play that at the right time. And all the way around, there are too many things going on that could ruin your position that you have no control of. And, you know, everybody has talked about before, myself included, how a stock can beat their expectations, but the market reacts badly because it didn't beat enough. The market was expecting more, and so the stock price still goes down. So at the end of the day, do you really want to associate yourself with a strategy that's a coin flip? And so with Vega being sort of wherever it wants to be on earnings, that's something that I don't like to do. It's hard to leverage Vega because you are trying to sell when people are expecting a move. So IV is increasing because people are saying there's going to be some big announcement and we're not sure if it's going to be good or bad. So as a seller, I can say, oh, I like high IV because I can collect higher premiums. But the reasons premiums are higher is because there's more likely to be a move, and that move could impact your position negatively. So yeah, even though IV is overstated, is it enough to come out ahead consistently? And I would say maybe, but I would rather choose a strategy that has so many factors backing me that I don't have to worry about some announcement killing my position. So yeah, so I did try for I gave it a try for a couple months where I was trying a pure Vegas strategy. So I would go in, choose the highest IV stock and sell a position and try to capture, let's say, do a very wide iron condor or something like that, or maybe an iron butterfly, trying to capture the decrease in volatility. And it was a 50-50 shot, basically, and I want something better than that. So that's just my experience. I'm not saying you can't do it. and be successful. So understanding gamma makes zero-day plays hard. So first of all, you can't even trade a zero-day play. That would be a play that expires today. You can't even do those on Robinhood, but in Tastyworks and other platforms, you're allowed to buy and sell, open and close contracts the day of expiration. But because gamma is going to whip your position around, you have to be more confident in the direction the stock is moving, obviously, because there's no time to work with. Yeah, so I generally stay away from zero day. I've done those before and occasionally will do them. But it's, again, only when I'm very confident in the direction or the turnaround of a stock. So generally, you should be building your strategy around the strengths of the options and understanding the way Greeks affect options. Again, primarily theta and vega, is what led me to my strategy, at least currently. And so understanding them, building as many factors into your strategy that helps elevate it to become a winning strategy is where the ticket is. Understanding the nitty-gritty of all of these and thinking about it, to me, is kind of a waste of time. But if you live options daily, which I do, at least to some extent, all of this becomes very easy and second nature. So I'm sure if this is the first time getting exposed to the Greeks, your head's going to explode and think I did a terrible job explaining it. That might be true, but really it's something that becomes second nature and something that you don't consider. And I can say I literally never look at Greeks, ever. It's not something I care about. The numbers don't affect me and my strategy. They're built into the concept of trading at a core level, and I'm higher level in my strategy that I'm personally not utilizing the Greeks. I'm sure there are people that are doing that, but that's not something I do. Last point I have here is I think all of the pricing is fair and automated, and I don't really believe in a free lunch kind of deal. So if you're looking for discrepancies, you're probably going to spend more time looking for those if you're looking at the Greeks. Now, maybe you think if you're defining a discrepancy as I believe this value of this stock is much higher than what it is, sure, obviously that makes sense. But if you're looking for a specific pricing discrepancy between a contract, you're probably not going to get it. Maybe the broker's showing a higher value or a lower value because there's not liquidity there. That happens a lot. And so you think, oh, I can get this filled at $200. And then you put it in, and if you're selling, it goes down to 150 and then down to 125 and then down to 100. So the true trading price on the market is significantly different than what it's showing. So there is a difference there between the fill and what the brokers are showing. If I could get it filled at 200, yes, that would have been a discrepancy. But now that I'm getting it filled for 100, it's basically right in line or even worse than what any other liquid market would be. So in my opinion, you can look for discrepancies, but it's kind of a waste of time. All right, so that is my take on the Greeks. In a one-sentence conclusion, it's nice to understand, but completely not worth incorporating into your trading. I have broker links in the description if you care. I don't care if you use them or not. I basically personally use Tastyworks at the moment for most of my trading, and then I use Thinkorswim a lot for looking at charts and that kind of stuff. I do have a lot of videos planned. I haven't been doing them recently because I've been caught up in trying to get the website as good as I can. Hopefully I can get back in a routine here where I can get these out every Friday. Certainly this video is requested, so if you have any requests, you can request a video and I will try to get it out that week. If you're not familiar with the site, you can track your stocks and options. Community members can publish their alerts. So I have a bunch of different calculators, and I handle rolling options, which basically no broker handles correctly. Some analytics, and best of all, it's all free. So anyway, I will say, as everybody does, these are just my opinions. So thank you guys, and if you have any questions, leave them in the comments below. Thanks.